In this video, we're going to do a problem where a monopoly is a price searcher in the domestic market and a price taker in the world market. A firm is protected from import competition, giving it monopoly power in the domestic market, where the inverse market demand is given by the following, where the subscript D represents domestic market. The firm also sells its product in the world market at the going market price of $40. So in the world market, the firm is a price taker, taking the going world market price as a given. The marginal cost of producing this good, regardless if it's sold in the domestic or world or foreign market, is given by the following, where capital Q corresponds to the output produced for the domestic market, and Q subscript F is the output produced for the foreign or world market. How much output does the firm sell in the domestic and foreign market? What price does the firm set in the domestic market? So the key here to profit maximization is that the marginal revenue in each market equals the marginal cost. The marginal revenue in the domestic market equals the marginal revenue in the foreign market equals the marginal cost. So the first thing we're going to do is solve for the marginal revenue in the domestic market. This is the inverse market demand in the domestic market. We're going to do a shortcut method here to get the marginal revenue in the domestic market. The marginal revenue will look like the inverse market demand, but with a slope that is twice as steep. So instead of having a slope of minus 0.2, the slope will be minus 0.2 times 2, or as follows. So the marginal revenue in the domestic market is just the inverse market demand with a slope that is twice as steep. The marginal revenue in the foreign or world market is just $40, the going market price or world price. So the first thing we're going to do is just set the marginal revenue in the domestic market equal to the marginal revenue in the foreign market. Doing that, and now solving for Q subscript D, the quantity in the domestic market. So subtracting 40 from both sides and moving this minus 0.4 Q subscript D to the other side. And now dividing through by 0.4, the firm will produce 150 units for domestic consumption. The next thing we're going to do, we're going to set the marginal revenue in the foreign market equal to the marginal cost. So the price in the world market is $40, which is the marginal revenue, and we saw the marginal cost equation on the first screen. And now we're going to solve for Q, subtracting 2 from both sides, and now dividing through by 0.1. The firm will produce a total of 380 units. And we know the total output here is split between the domestic market and the foreign market. So the total output being produced by the firm is 380. We just solved that the firm will produce 150 units in the domestic market, so we just need to solve for the amount of output for the foreign market. So 380 minus 150 means the firm will produce 230 units in the foreign market and sell each of those units at $40 each. The next thing to do is let's get the domestic price. We know in the domestic market this firm will produce 150 units, so we're just going to plug this 150 units into the inverse market demand, and we'll see that the firm will sell its product in the domestic market at a price of $70, selling 150 units, and as we just saw, the firm will sell then 230 units in the foreign market at the world market price of $40. Okay, that's it.